Welcome back to the deep dive. Today, we're doing something a little different. We're peeling back the layers on something super common but maybe not fully understood: loans.
Mm-hmm.
Specifically, we're diving deep into the intricate rules around borrowing and lending from a Shari'ah perspective. We're looking at Standard 19 on Qard, which just means loans.
That's right.
Think of this as, your personal shortcut to understanding the real details of Islamic finance when it comes to debt. Our mission: to pull out the most important bits of knowledge from this key document.
Yeah, it's quite foundational.
We'll unpack what a card really is, its core parts, and maybe most interestingly, how these old principles actually work in today's financial world.
Right.
From your current account right down to that ATM fee.
And just to frame it properly, it's good to know what this standard actually covers and what it doesn't.
Okay.
It definitely covers loans, obviously, and all the costs and benefits tied to them. That's whether an institution is the lender or the borrower. But importantly, it carves out things that aren't loans. So like a deferred price in a sale or different kinds of investment accounts. Those are separate things.
Got it. So it keeps the focus tight just on the loan itself.
Exactly. Helps keep things clear for our discussion.
Okay, right. Let's dig into the core then. So how does Standard 19 actually define a card? Fundamentally.
Well, at its heart, a Qard is defined as transferring ownership of fungible wealth to someone who must return an equivalent amount.
Fungible wealth. Okay, that word fungible feels pretty key there. Could you break that down a bit? What does fungible mean here, and why is it so basic to the definition? Maybe an example.
Absolutely. Fungible wealth, or mithly as it's termed, means something where basically one unit is identical to another. It can be replaced by another unit without any real difference in kind or quality.
Uh-huh.
Money is like the classic example, right? If I lend you $100, you don't owe me those exact same notes back.
No, of course not.
Just an equivalent $100. So the principle is returning an equivalent, not the identical thing. Yeah. And this is vital because it sets up repayment in kind, not necessarily in fluctuating value. Helps avoid uncertainty.
Okay, that makes perfect sense. So not a unique painting, but bags of flour or money. Interchangeable value.
Precisely.
So given that, what are the essential bits, the pillars, you could say, that make a Qard valid under these rules?
Okay, so for a Qard to be valid, you need four clear components. First up is the offer and acceptance.
Right.
And it's not just any casual chat. It needs specific terms like the word Qard itself, or salaf, which means in advance, or, any phrase that clearly gets the meaning across.
Okay, clear intent. What's next?
Second, you have the lender, the muqrid. This person or institution must be capable of making what's effectively a donation.
A donation.
Meaning they have full ownership and discretion over the asset they're lending out.
Ah, I see. And the borrower.
Third, the borrower, or muqarid. They need to be capable of handling their own affairs, legally competent. And crucially, they take full ownership of the loan amount.
Okay.
And at the same time, an equivalent liability, a debt, is established on them.
So when you say equivalent liability is immediately established, what does that mean practically? They can't just give the money back and say, never mind, once it's transferred? Or is it deeper?
It's pretty much that, yeah. Once the Qard is done, the borrower owns the funds, but at that exact same moment, the debt is theirs. It's an immediate responsibility.
Right.
They can't just refuse it then. The obligation to repay is locked in. It really shifts their position from just receiving money to actively owing it.
Okay, that's clear. And the last pillar.
And finally, number 4, the subject of the loan itself, the thing being lent.
Mm-hmm.
It has to be a valuable asset, or mal mutaqawwim, something Islamically permissible and having actual value. It must be known or specified, ma'lum, so everyone knows exactly what's being lent.
No confusion.
None. And, as we said, it needs to be fungible, mithly. And the core idea here is returning an equivalent amount in kind at the agreed place of delivery.
So for you listening, what does all this tell us? How does this definition, these conditions, change how loans work in this system? It seems to shift it, doesn't it? From just a transaction to something more beneficence. The lender takes a risk, but doesn't profit just because time passes on the money.
That's a very good way to put it. It underlines the ethical framework.
Right. So now we get the basics of Qard. We absolutely have to talk about the elephant in the room for Islamic finance: riba, usury, interest. This is where it gets really, really critical.
Yes, this is absolutely central. Standard 19 is incredibly clear on this. It's strictly prohibited, it's haram, to stipulate any kind of increase for the lender within that loan contract.
Any kind. That sounds broad.
It is. It covers any type of increase. Doesn't matter if it's about the quality, getting back something better, or the quantity, getting back more, or even a specific extra item, or just any other kind of benefit. And it doesn't matter when it's stipulated either, whether it's in the original contract or maybe later if repayment is delayed, or even just during the loan term.
So no late fees that benefit the lender?
Not in the sense of an increase for the lender, no. And it also doesn't matter how it's stipulated, written down explicitly, or just, understood by custom between people.
Okay.
This complete ban is really the bedrock. It's all about preventing unjust gain just from lending money.
That is incredibly comprehensive. I mean, it leaves almost no wiggle room. Are there any sort of surprising details or conditions that, despite all that strictness, are allowed in a Qard contract? There must be some practical things.
That's a fair question.
Yeah.
And yes, there is one very specific condition that it was permitted as an exception.
Okay.
It's allowed to stipulate that the repayment happens in a different country than where the loan was given.
Ah, for practical reasons? Like international business?
Exactly. It allows for that without it being considered riba.
Okay, so that stuff's stipulated in the contract. What about benefits that aren't formal conditions? Like if the borrower just decides to give the lender a little something extra, how does the standard handle those unconditional gifts?
Right. This is a more nuanced bit. It's not allowed for a borrower to give an item or provide some benefit to lender during the loan term if that gift is clearly because of the loan.
Ah.
And especially if it wasn't something they normally did before the loan existed.
So prevents backdoor interest.
Precisely. It stops interest creaking in through, informal gifts. But, interestingly, the opposite situation is allowed and even encouraged, though not required.
Okay.
If a borrower, totally out voluntarily, gives an increase at the time of repayment, maybe they give back a bit more money or a better quality version of what they borrowed, or just include a small gift.
Uh-huh.
As long as there was absolutely no prior condition, no agreement, no custom demanding it, then that is permissible. It's seen as a good deed, actually.
Regardless of whether it was money or something else borrowed?
Yes, applies either way. It emphasizes generosity, but only when it's truly, genuinely voluntary.
Fascinating distinction. Okay, let's shift to some practicalities then. Can a Qard have, a due date? Can you set a term?
Yes, absolutely. Stipulating a term, an ajal, is explicitly allowed.
Okay.
And if a term is set, then the borrower isn't required to pay back before that date.
Makes sense.
And conversely, the lender cannot demand repayment before the term is up. It creates certainty.
And if no term is set?
Then the borrower has to repay whenever the lender asks for it upon demand.
Clear enough. What about linking a loan to another deal? Could I say, I'll give you this loan, but only if you agree to buy my car?
No, definitely not. That's strictly not allowed.
Right.
It's prohibited to make the loan conditional on another compensatory contract, like a sale or lease, anything like that within the loan agreement itself.
Why is that?
Well, the idea is to stop people using the loan as leverage, basically, to force someone into another profitable transaction. That could become an indirect prohibited benefit, kind of like riba again.
Okay.
A Qard needs to stand alone as a benevolent act, free from those kinds of hidden strings.
Right, keeps the integrity. What about fees then? Say, I just help arrange a loan between two other people. Can I charge for that service, like a broker fee?
Yes, that is permissible. You can charge a fee for facilitating a loan for a third party.
Okay.
But, and this is a really important, but it has to be genuinely a fee for the service you provided, the work you did.
Not just a percentage of the loan.
Exactly. It cannot be a pretext for interest-bearing lending.
Yeah.
Whether that's explicitly agreed or just kind of a wink-wink agreement between institutions, the fee is for the service, your effort, not tied to the loan amount or how long it's outstanding.
Got it. And what about the institutions themselves? The banks or finance houses providing Qard loans. Can they charge for their own expenses in providing these loans? This feels like a huge operational question.
It is. And yes, institutions can charge for loan services. But another big condition, only up to the amount of their actual direct expenses.
Actual direct expenses, how precise do they need to be?
Very precise. It's crucial. The charge doesn't create any profit beyond covering those direct costs. Ideally, you track the specific cost for each individual loan.
That sounds difficult.
Can be. So if tracking individual costs is too hard, they can calculate general direct costs related to providing loans and distribute that proportionally across all the loans.
Okay, but what counts as direct?
That's the critical part. Direct costs are things immediately related to processing that loan. But indirect expenses, things like staff salaries, the rent for the building, furniture, utilities, those are not included in these allowable service fees.
Hold on. If you can include salaries and rent, that sounds like a massive challenge for the business model. How do institutions realistically cover their huge overheads if they can only charge tiny direct costs on loans? Are we talking about a totally different kind of bank here?
You've absolutely nailed a core challenge. It means these institutions have to be really innovative. They need to find their income from other places. From other Sharia-compliant activities that are designed to be profitable. Things like trade finance, murabaha, for example. Or investment partnerships, mudarabah, musharaka. Their business model is fundamentally different from a conventional bank.
Wow.
They often rely on profits from those other activities to cover the general overheads, rather than trying to profit from the act of lending itself. It really underscores a distinct ethical approach to finance, separating lending from profit generation.
That distinction really drives home just how different this whole framework is. Okay, so if we connect this to the bigger picture, let's look at how these principles actually work out in modern financial services. We picked 4 key examples, and you, our listener, might recognize some of these from your own banking.
Okay, sounds good. First up, current accounts, your everyday checking account.
Right.
Fundamentally, these are seen as Qard. Loans.
Yeah.
The money you deposit, the institution takes ownership of it, and it becomes a liability on their books. They owe it back to you.
Okay, so it's a loan from me, the bank.
Effectively, yes. And because it's a Qard, the institution cannot charge you a fee for services that are just inherent to holding the account, like a monthly fee just for having the account open.
Right.
However, it is okay for them to offer specific services related to payments or collections, processing your checks, transferring funds, managing payroll for a business, and they can charge a fee for those specific value-added services.
And they can charge different customers different fees for those.
Yes, they can differentiate for those specific services with or without a fee. It's about the service, not just holding the deposit.
Okay, what's the second example?
Second, loan prizes. When banks offer gifts or prizes to account holders.
Ah, yeah, like prize draw.
Exactly. Now, it is not allowed for an institution to offer physical gifts or cash benefits or services that aren't related to basic deposit withdrawal functions solely because someone holds a current account, which is a Qard.
Why not?
Because that could be seen as an indirect incentive, a return on the loan, the deposit, which skirts close to riba. However, if the bank runs, say, a general prize draw, or has a loyalty program that's open to all its customers, regardless of whether they have a current account or some other product, then that is generally considered permissible. It's not tied exclusively to the course nature of the current account.
Subtle distinction there. Okay, third.
Third example, cash withdrawal fees from credit cards at ATMs.
Oh, yeah, those lovely fees.
Right. Now, the way this is viewed is that the fee is actually a charge for a separate service. The service of providing you cash instantly via the ATM network, separate from the loan itself, which is the credit line on your card.
Okay.
But for this fee to be permissible, it must meet certain conditions. It has to be a fixed amount.
Not a percentage.
Absolutely not a percentage of the amount withdrawn. That would link it directly to the loan amount and make it look like interest. It also has to be, within a reasonable market rate for that ATM access service.
Right.
And they can't use dodgy conditions for the withdrawal or factor in repayment time. None of that. And if you withdraw in a different currency, the standard exchange rate has to apply.
Yeah.
It's purely about charging for the convenience, the access, not the money borrowed.
That's quite specific. Okay, and the last example.
And finally, number 4, account statements between institutions and correspondents. This is more behind-the-scenes interbank stuff.
Okay.
It is permissible for banks or financial institutions to have agreements with their correspondent banks overseas to cover each other's uncovered accounts temporarily without charging interest on those overdrafts.
Ah, so it helps international payments flow smoothly.
Exactly. It facilitates smooth operations between banks without falling foul of RIBA rules.
Looking at these 4 examples, what really stands out to you, it's just, fascinating seeing how meticulously these old principles get applied, trying to make sure every single service fits the ethical framework. Even in today's complex world, it looks like a constant balancing act.
It absolutely is. And I think it reinforces that principle we mentioned earlier. Knowledge is valuable, but really only when it's deeply understood and then applied correctly.
Yeah.
We've seen how these, quite profound principles really guide modern financial practices step by step. It highlights the incredible attention to detail needed in Islamic finance to just constantly check and ensure you're avoiding prohibited things like riba, even in transactions that seem simple on the surface. It really is a testament to a whole integrated system of financial ethics.
Absolutely. So we've taken quite the deep dive today into the Qard standard. We've uncovered, I think, some surprising insights from its core definition and those strict pillars, right through to how it shapes things like your current account or those ATM fees.
Yeah, quite a journey through one standard.
So as you go about your day, here's something to maybe mull over. How do these really detailed principles for a simple loan, a card, actually influence the way financial products are designed and innovated in different parts of the world? What impact could this unique approach have on bigger things, like financial inclusion, or even how global finance interacts?
That's a great question to leave people with.
Something to think about. We'll see you next time on The Deep Dive.